I'm Tom Morris. I'm the product specialist covering the global sustainability and global equity unconstrained strategies. Global sustainability performed well in Q3 of this year. What we've seen in the past 3 months is a rotation in the market, particularly in September. What has happened is that as bond yields have risen as a result of a combination of factors, partly due to increasing energy prices and expectations for inflation, but also there has been a revision downwards for the growth of the global economy. Now, that combination of factors has been quite challenging for stocks with a growth orientation, to which we in global sustainability have a slight bias. That has been a bit of a headwind, but fortunately, through our balanced exposure, particularly to some names in the energy sector, like Shell, we have been able to create strong performance despite this. We also think that the underlying fundamentals of the companies in which we are invested remain robust, and that should continue to underpin our long-term outperformance. Of course, in Q3 we made a number of transactions. One was in a company which makes fluid solutions, which to you and I is essentially cleaning products. Now, this company, if you go into any large institution like a factory, a school, a restaurant, a leisure center, whatever it is, if they have got some sort of cleaning product, they will be providing the chemicals and products. They also have products which are used for a range of other more sophisticated uses, but that is the primary part of their business. Now, this company is very strong, a great name. It's been generating high single-digit returns for the last 10, 20 years, and we still like it from a general fundamental perspective. But because it has this exposure to those more cyclical parts of the economy, like restaurants and leisure industries, the valuation reached a very high level relative to its fundamental business, so we exited the position. We also made a couple of other exits in the consumer goods sector, simply because we think that their growth profile and their ability to charge higher pricing relative to peers is lower than perhaps the market's giving them credit for. On the other hand, we have also initiated a position in a semiconductor manufacturing equipment name. Now, this company has a range of functions in terms of where it sits within the value chain for constructing a semiconductor. These are, without getting too technical, doping, deposition, process control. So various steps in the very long process which gets you to the eventual end product. Now, because of the nature of the semiconductor industry, i.e. its complexity, the number of different participants which are involved in the process, this company has a very wide moat in terms of competitors. No one is going to muscle into their space, but it is also increasing its larger revenue pool by virtue of access to things like services, but also the photovoltaic cell market, so solar panels. It's a really interesting name, a great fit with global sustainability, and also when we bought it on a very good valuation. So in terms of the outlook heading into Q4, we really are sort of doing a victory lap of all the themes which have emerged in 2021. The three that I would pick out as being the headlines really are, firstly, the persistence of COVID and the longer term behavioural changes that it's causing. The second is increasing government action in terms of regulation across China. And then the third is rising inflation and what the global governments and central banks are trying to do to tackle that. Now, it's important to say before we get stuck into this that we pick stocks which should be able to outperform regardless of these issues, but they do present a context in which we operate. So the first, COVID, I think we've seen generally across the board that while countries which have been able to vaccinate have somewhat been able to return to normality, those longer term behavioral trends in terms of things like hybrid working or reluctance to travel, or even just a push towards more sustainable living, have continued to persist even though the country is more or less back to normal. On the other side, we've seen in countries, for example, like Vietnam, which, having previously had a very good pandemic, have struggled in recent times, and that has had knock-on effects for global supply chains. The second, in China, we've seen that as President Xi starts to ramp up his role as leader, and this is ahead of next year's large party conference, the theme of common prosperity and what it means for the Chinese economy and how he is willing to implement that has really had quite a large effect on listed companies in China. Now, without getting stuck into too much of the detail, the real question is, how willing is President Xi to, I suppose, damage the financial reputation of China or have an impact on its financial structure in order to achieve those goals? And that really is the big question going into Q4 and beyond. Then finally, in terms of inflation, what we've had in 2021 is at the start of the year, this very strong run in companies and indeed sentiment for stocks which were languishing in 2020 because of the pandemic. In Q3, so more recently, what we've seen is that actually, rather than being a strong anticipation for growth, we've had revisions downwards of growth, but that's come because of supply chain bottlenecks, particularly in the energy sector. So we're seeing prices for everything from commodities, energy, but also labor rise at the same time as growth expectations have moderated. That creates quite a challenging environment for companies and managements. And for us as stock pickers, our focus really has to be on picking those names which are able to weather those difficult conditions and have the pricing power to offset any of those concerns.
Allianz Global Investors.